While the headlines screamed about a $3 trillion wipeout in the stock market this week, something almost no one is talking about happened quietly in Washington. The President of the United States, on Truth Social, told the most powerful banks on earth, "We are not going to allow it." Not a press secretary, not a staffer, the President, personally. And here's the part that isn't being explained to retail investors the way it should be. This isn't just political noise. This is a direct confrontation between legacy financial power and a new monetary architecture. And XRP is sitting exactly at the center of that battle. The world missed the signal, but you won't. Let's decode this. Welcome back. I'm glad you're here, because today we are not going to chase fear. We are going to do what we always do: strip away the noise, follow the data, and understand what is actually happening underneath the surface. Today's briefing covers 5 interconnected moves that together tell a story Wall Street does not want retail investors to piece together. Let's jump in. Most people watching this week's market chaos are focused entirely on the wrong thing. They're watching the red candles, the tariff headlines, the stock sell-off. That's the distraction. The real story is happening in a room most retail investors have never heard of. And it involves a war between traditional banks and the emerging digital asset infrastructure that is being built around them. Here's what you need to understand. The Clarity Act, the market structure legislation working its way through Congress, is not just a regulatory bill. It is the legal declaration that separates the old financial system from the new one. And the banks know it. Think about what this bill actually does. It defines digital assets. It draws clear lines between what is a security, what is a commodity, and what is a utility token. And for an asset like XRP, which has already been through the most expensive, most scrutinized legal battle in crypto history, regulatory clarity isn't a risk. It is a catalyst. Now ask yourself the brutal question: why would the most profitable banks in American history spend political capital lobbying against a bill that's supposed to protect consumers? The American Bankers Association's stated concern is deposit flight. That if stablecoin platforms can offer yield, customers will pull money out of bank accounts. Let that sink in. Banks that are posting record profits are terrified that Americans might earn more money on their money. President Trump said it plainly this week: Americans should earn more money on their money. That's not regulatory debate. That's a power struggle. And the entity positioned to move money across this new financial plumbing, fast, cheaply, and without a bank in the middle, is exactly the asset this channel has been analyzing for years. The pipes are being laid. The question is, who built them first? Let's talk about the math that the crowd always misses. The Clarity Act opposition is centered on deposit flight. Banks are warning that stablecoin rewards could pull hundreds of billions out of the traditional banking system. Here's what's fascinating about that warning. It's actually the bull case for digital asset infrastructure stated in reverse. Consider the numbers. There is approximately $27 trillion locked in nostro vostro accounts globally right now. Money sitting idle in correspondent banking relationships, doing nothing productive except serving as liquidity buffers for cross-border settlement. $27 trillion. Frozen. Parked. Waiting. The global cross-border payment market processes over $150 trillion per year. The daily Forex market alone turns over $7.5 trillion every single day. These are not hypothetical numbers. These are the actual pipe widths of global finance. Now, let me show you why price matters in a way most people never frame correctly. XRP's total supply is fixed at 100 billion tokens. Circulating supply sits around 55 to 57 billion. Exchange reserves have been declining. When a financial institution needs to move $50 million across borders in seconds using XRP as a bridge asset, a higher XRP price is not just nice, it is a design requirement. At $1, you need 50 million tokens to move that transaction. At $10, you need 5 million. At $50, you need 1 million. Fewer tokens required per transaction means less slippage, less market impact, and more efficiency at institutional scale. This isn't a prediction. It is the logical mathematical outcome of any liquid bridge asset operating at institutional volumes. JP Morgan's own research team put out a note this week acknowledging that if market structure legislation passes by mid-year, their words, not mine, it could, quote, serve as a positive catalyst for crypto markets into the second half of the year. Jamie Dimon is lobbying against the bill in Washington. His own analysts are saying its passage restarts the bull market. You don't need to read between the lines on that one. The lines are reading themselves. Let's be clear about what institutional validation actually looks like, because it doesn't look like CNBC coverage or trending hashtags. It looks like quiet, irreversible moves made by entities with fiduciary obligations. Here's what happened this week that retail mostly scrolled past. Kraken, the crypto exchange, was just granted a limited-purpose master account at the Federal Reserve, approved by the Kansas City Fed, 1-year initial term, direct access to the Fed wire system. Let me translate that for you. Kraken can now move US dollars directly on the same payment backbone that major banks use to settle trillions of dollars daily, without needing a bank intermediary. This is not a small update. This is the first time a digital asset company has been granted direct access to the Federal Reserve's payment infrastructure. Senator Cynthia Lummis called it clearly this week. You're going to see banks buying digital asset companies and digital asset companies buying banks. That is a senator, on the record, describing the merger of two financial systems, the legacy one and the one being built on chain. Morgan Stanley filed this week to launch its own spot Bitcoin ETFs. They are the first major U.S. bank to take this step, and through their e-trade brokerage platform, they plan to allow customers to directly hold and trade digital assets. The largest institutional brokerage network in the country is now integrating crypto at the account level. That is not exploratory. That is structural repositioning. Meanwhile, SoFi and MasterCard announced an expanded partnership this week to enable SoFi USD, a stablecoin, as a settlement option across MasterCard's global payments network. They selected BitGo Bank and Trust for the stablecoin infrastructure backend. A major payments network is now settling in digital dollars across its global rails. Ask yourself, does a company like MasterCard make that move without absolute legal and commercial certainty about where this industry is heading? They don't move on rumors. They move on architecture. While retail investors are watching stock portfolios bleed and wondering whether crypto is dead, the architects of the next financial system are signing agreements, filing registrations, and plugging into the pipes. Smart money doesn't panic. It positions. Here is where we are on the timeline. JP Morgan has placed its mid-year estimate on Clarity Act passage. Specifically, they've said the legislation is, quote, likely by mid-year. That is Q2 into Q3 of this year. Others quoted this week said that if the bill does not pass by then, it would be a tremendous setback for markets. The White House is now personally engaged. President Trump met directly with Coinbase CEO Brian Armstrong this week, a clear signal that the administration is not treating this as a background legislative issue. The Genius Act, the stablecoin bill, is the opening act. The Clarity Act is the main event. Together, they form the legal operating system for tokenized finance in the United States. When the Clarity Act passes, the risk premium embedded in every digital asset reprices overnight. The institutional money that has been sitting at the gate, the compliance-constrained capital, the pension fund allocators, the sovereign wealth managers who require legal certainty before touching an asset class, those gates open simultaneously. The fuse is lit. The question is only when it reaches the charge. And beyond the legislation, watch tokenization. BlackRock has signaled plans to bring $3 to $5 trillion of its ETF assets onto blockchain rails within the next 12 months. That is not theoretical. The on-chain migration of institutional capital is already beginning. The plumbing of global finance is going on-chain. Here's what nobody wants to say out loud. We are currently living in the last period where retail investors can accumulate digital assets at these prices. Not because a pump is coming next week, but because the structural shift I just described, the Clarity Act, Kraken's Fed account, Morgan Stanley, MasterCard, BlackRock tokenization, that shift doesn't reverse, it accelerates. Exchange reserves for XRP are not growing. Institutional accumulation is directional. Tokens moving into long-term institutional vaults, multi-sig custody solutions, and ETF-wrapped products don't cycle back to market because the price went up 10%. They are parked for years. There is a reason Google searches for Bitcoin and crypto spiked this week, even as markets sold off. When traditional markets bleed, people who've never considered digital assets start asking the question for the first time. Some of them will wait for clarity. Some will act now. The gap between when the infrastructure gets built and when the mainstream recognizes it has a price. Right now, that gap is the opportunity. We are moving from an era of abundance into an era of scarcity, and the clock on that transition is not theoretical. It is legislative. I know what this week felt like. Almost $3 trillion erased from the stock market in 5 days. Crypto following equities lower. Uncertainty about tariffs, interest rates, unemployment ticking up. The Fed trapped between inflation risk and recession risk. I understand why people are questioning everything right now. But here's what I'm trained to do as an analyst. I separate noise from signal. The noise this week, red candles, macro fear, political drama in Washington. The signal this week, a president directly calling out banks for blocking crypto legislation. JP Morgan's own team calling Clarity Act passage a bull market catalyst. The first crypto company ever getting a Fed master account. Morgan Stanley filing to issue spot crypto ETFs. MasterCard settling in stablecoins. Being early in a structural shift feels exactly like being wrong, right up until the moment reality catches up with the architecture. The question I'd ask yourself is not whether the thesis is broken. The question is, when the Clarity Act passes, when tokenization accelerates, when the institutional gates open, who will still be holding, and who will have been shaken out by the noise? The institutions are not being shaken out. They are shaking others out. There is a difference. This week, President Trump told the banking system directly, "You will not undermine the crypto agenda." JP Morgan's own analysts said legislation could restart the bull market. Kraken got a Federal Reserve master account. Morgan Stanley entered the ETF race. MasterCard settled in stablecoins. And Google searches for crypto surged even as fear gripped global markets. None of that is noise. Every single one of those is a brick in the same building. Price is a distraction. Infrastructure is the reality. And the infrastructure being built right now around digital assets, around the XRPL, around tokenized settlement, around regulated on-chain finance is the most significant architectural shift in global payments in a generation. The informed don't watch the chart and panic. They watch the structure and position. If this breakdown gave you clarity, drop a comment below with the word structure. I want to know who's actually paying attention. Like the video, share it with someone who needs to see through the noise, and subscribe if you want to keep getting this level of analysis. Stay patient, stay rational. The math doesn't lie, and the system is almost complete.